background other than taxes and financial planning. So Scott Oeth with Cahill Financial Advisors here, and very excited to have special guest, Dr. Russell James of Texas Tech University. And we're going to talk about charitable giving and the tools and techniques of charitable giving and philanthropy and some of the special tax advantages that are potentially at play. And really looking forward to this one. I've studied in this area a bit. I've worked on the Chartered Advisor and Philanthropy program, and Dr. James, your name came up time and time again. And that's a program where I was a financial advisor, but I was in with many professional fundraisers from charitable organizations. And so your work, your writing, your presentations were frequently cited. And so we know you are expert, seen your presentations before. So really appreciate you taking the time to join us and give us this overview. And by way of compliance disclosures, I need to throw out, we are independent organizations, not affiliated with each other, other than I should probably disclose that from our household, money does flow to Texas Tech's financial planning program because our oldest is in school there, and very happily so. So, very unique program. Texas Tech University is regarded as one of the top handful of programs in the country in terms of financial planning. Almost every college has some type of finance program, but y'all were really the leaders in focusing on personal financial planning. And am I getting it right? The first program to develop a PhD in
Absolutely, yes.
Planning? Yeah. So a special program, and you have a very unique special focus area within that, out of the array of investments in tax, retirement planning, insurance. Your specialty is philanthropy and charitable giving. And I love the name of your blog, and it's in your bio, Encourage Generosity. Do you want to maybe just tell us a moment what inspired that and kind of your personal mission and why you're in this field?
Sure. So that really just underlies the kind of core human value we're talking about here in talking about charitable options is that, we're doing something that's fundamentally important of talking to people about the impact that they can have with the resources that they have. And, it can be exciting. And of course, as advisors, what we want to do is help them give smarter, right? What are some ways that we can make your giving more impactful by getting the government to match part of your giving so that they're going to be paying for part of that impact that you're trying to make. So yeah, absolutely. Encourage generosity is kind of my research focus, and happy to share some ideas on how to do that effectively today.
That's great. That's great. I love it. Yeah. I mean, personally, I find it to be a very interesting and rewarding field. I've always loved investments and economics, and very interesting kind of big picture of what's going on in the world and what's happened in the past. And I love the puzzling and problem solving of taxes and estate planning. And it feels like you're playing a very complicated game. And so I enjoy that. And putting those things together with real people and their situation and their goal, that feels so much more important than just trying to manage a portfolio in isolation. But out of those areas, especially, I remember hearing the term, going from success to significance, or, using those dollars, using the financial resources that have been accumulated to, really benefit causes close to people's heart is fantastic. Whether it's saying, wow, things worked out really well, what can we do now? Or I think something that doesn't get talked about enough maybe is, as people are on the way up, planning and really budgeting and saying, we want this to be part of our lives and part of our plan. And how do we use financial planning tools to help identify, funding a specific goal over time? So
yeah, for sure. For sure. Yeah.
Well, I know you have a great presentation, and so I'll try and get out of your way, and may have a few questions on the way, but I'll turn it over to Dr. James here.
All right. Well, thanks so much, Scott. So I'm just going to share some ideas that are smarter ways to give, and we're going to be looking at some top tax tips, especially at the end of the year as we start thinking about giving strategically. And here's some ideas to keep in mind. As I mentioned a minute ago to Scott, that what we're trying to do here is to get the government to match your charitable gift. It makes your giving more powerful. So we actually want the government to pay part of the cost of your gift. Now, that'll come up through two ways. One, you're probably already familiar with. That's the tax deduction, which is good if you happen to be itemizing. But there's another way that's actually even more powerful, doesn't require itemizing. And that's not a tax deduction. That is instead tax avoidance. So when I talk about tax avoidance, this is the idea of you have an upcoming tax bill and it just disappears. In other words, you've got income that you've earned, but now you never have to pay taxes on it. Or maybe you've made a profitable investment, but now you never have to pay any capital gains taxes on it. Now, this approach is actually even more powerful because it doesn't require any itemization. Beyond that, it's actually more powerful than a deduction for another reason. If you get a tax deduction, that's great, but your reported income is still going to be high. It just makes your taxes lower. If you engage in tax avoidance, both your reported income and your taxes are lower. Now, that can help with a lot of things, because if you can keep your reported income lower, that can help with things like your Medicare Part B and D payments, your eligibility for a whole host of tax benefits, whether that has to do with IRAs or education tax benefits, even adoption credits, child tax credits, and things like that. So we're going to take a look at 5 examples of where we can engage in tax avoidance with charitable giving, and then we'll talk a bit about tax deductions as well. So the first thing I want to mention is giving appreciated assets. Now, why this is so powerful, it's very straightforward. It's the idea that if I write a check to an organization, I can get a tax deduction for that. Maybe I can use it, maybe I can't. But if I make that same gift as appreciated assets, if I've held them for more than a year, I not only get a tax deduction of the same size, but I get to avoid paying all those capital gains tax on those appreciated assets. So just a real quick example, let's suppose I write a $100,000 check to a nonprofit. I get a deduction for that. The top benefit from that, if I'm at the top tax rates, is about $37,000. However, let's suppose instead of writing a check for $100,000, let's suppose I've got some shares of stock that I bought for $10 a share. It's now worth $100 a share, and I donate those instead. Well, not only do I get a tax deduction of the same size, but I also get to avoid paying all that capital gains tax that I would otherwise have to pay. So that makes it even more advantageous because I get a double tax benefit. Now, if I'm not itemizing, I can't even use the deduction, but I can still use that avoidance of capital gains taxes. Now, this is true in areas such as Texas, where we don't have to pay state capital gains tax, but it's even more powerful for any folks that may be in states where you also have to pay that state capital gains tax. Now, the second suggestion relates to the first, and that's the charitable swap. Oftentimes I'll talk to somebody and they're thinking about writing a big check to charity. And I say, well, what about giving appreciated assets? And I might hear something like, oh, yeah, I've got those shares of Apple stock and yeah, they've gone up in value, but I don't know, the market's kind of down right now. I want to hang on to those shares. So I don't think I'm going to donate those. And my response to them is, oh, you don't need to change your portfolio at all. You just take that cash that you were going to have sent to the charity and you use it to buy brand new shares of Apple stock. You then send the old shares of Apple stock to the charity. Notice your portfolio doesn't change at all. You own the same number of shares of Apple stock before as you did after. The only difference is you've shipped out the old shares and you now own brand new shares. Since you just bought them, there's no capital gain in those shares. So that means you have not changed your portfolio, but you've wiped out that capital gain. The cool thing is this is something we can do in the same day at the same moment because there's no waiting period. If we were dealing with lost property, we've got a waiting period. It's called the wash sale rule, but we never donate lost property to a charity that we want to sell, take that valuable tax loss, and then we can give the charity something else. Scott, did you have a thought?
Oh, yeah, I was just going to say, I love this technique. It's a great one. It's both these are things that we commonly do with clients. And I think one of the key things that we try and stress with people is wonderful. If there's something you want to do, a cause you want to support, hold on to the checkbook for a moment and give us a call and let us look at your situation and see if we can identify something like this in your portfolio because of that double benefit that you were describing a slide back. So yeah, I think it's fantastic.
Yeah, absolutely. You know, as a financial advisor, I describe this as a tax benefit you lose every time you write a check instead of
Yes.
giving those appreciated assets.
Mhm.
And by the way, one of the most convenient ways to do this is actually to use a donor advised fund where we would ship the shares or whatever the appreciated asset is to a donor advised fund. And then we simply send checks out to the various organizations. And obviously there I'm promoting Texas Tech as one of the places that you can send money to with the graphic. But you know, these donor advised funds, there's actually donor advised funds that are set up to take any kind of valuable asset. You know, not just stocks, but also real estate, and honestly, everything from unharvested crops to a partial interest in a racehorse to, in one case, an elephant ride business that was in India that had to be held for 3 years before it was sold. So the
Amazing.
point is that there are donor advised funds that are designed to deal with weird assets. So again, this can move beyond the traditional of you know, appreciated stocks. And anytime we've got these valuable appreciated assets, there's often going to be an opportunity to either give them directly to a charity or give them to a donor advised fund, and then we can ship the cash out to any of our favorite charities.
I think if I can jump in for just a
Yeah,
moment,
go for it.
the donor advised fund we use very frequently, and a few things I think are so interesting. It's all the elements you show, but there's like a time machine element, right? And that you can make the gift, you get the tax deduction for the gift. If you're gifting appreciated assets like you're talking about, you don't have to recognize that gain. It gets sold within the donor advised fund. You don't have to pay the capital gains tax. Um, but then you can make the gifts over time. And I think there's a few advantages to that. You know, if you're looking to rebalance the portfolio or there's a reason to make a change, it works that way. And you can distribute them out over time. And something you touched on, we did an earlier session like this talking about considerations around relocation. You know, we have a lot of Minnesotans who love Minnesota, but as they get on to retirement age, they really think about moving someplace warmer in the winters. And the idea of, well, gee, Florida, Texas, Nevada, Tennessee, there's no state income tax there. And for many cases, that's a lot of money. And so the idea of contributing to a donor advised fund, either maybe in the last few high working income years. So, hey, you're in your last final 5, 3 couple of years of employment.
Yeah,
Let's bunch those tax deductions in those high years.
absolutely.
And also, boy, if you're paying the state of Minnesota 9.85%, maybe get that deduction there. And then, you know, when you're down in Texas, you can distribute
Come to
it out at a
Texas.
lower
That's
rate.
right.
Mhm.
Yeah, absolutely. So it does, and we'll look at some other ways that we can coordinate when we might
Yes.
take the standard deduction, for
Mhm.
example. By,
Right.
you know, we pick a year, we have that target year where we want the big deductions, and we just, if we've got the financial flexibility, let's pre-fund all of those next several
Yes.
years of charitable giving by stuffing it all in now, taking that big deduction now. So you're absolutely right. These donor advised funds offer a lot of that flexibility. So a really great strategy to use. Another great strategy is to consider IRA gifts instead of required minimum distributions. Now, folks are probably already familiar with, but retirement accounts generally have 3 different life stages. You've got early distribution before age 59 and a half. We generally want to avoid that because unless it's for some specified cause, we're going to have to pay a 10% penalty as well as paying the income tax on that. Then we've got regular distribution between 59 and a half and 72, where there's no penalty, but of course you have to pay income taxes on anything you take out. And then once you hit age 72, we hit required minimum distributions. Now, of course, you got to take that money because if you don't, government's going to give you a 50% penalty on all that you don't take. That is steep. So you got to take that money out. And if you wanted to, you could turn around, you could make a gift with that. And those things in a perfect world theoretically could mostly offset, but it's a little tricky to make that come out perfectly, right? Because you've got to be itemizing, no income giving limitations. And frankly, it's still going to make your income go up. And there's lots of effects from increasing your AGI. So the better way to do it is we can actually send money starting at age 70 and a half. We can send that money directly from an IRA to a charity. Now, the great part about this is that this is this is an example of tax avoidance. This is money you've earned, but you've never paid taxes on it. Now you never will pay taxes on it because it went directly from the IRA to the charity. And notice, even though required minimum distributions don't start till age 72, this starts at age 70 and a half. So you can do this one right away. Now, some notes on this is that this is for IRAs and IRA rollovers only. So if you're starting out with a 401k, 403b, or some other animal, you just have to convert that to an IRA rollover first. Once you convert it, then you can make these kinds of gifts. A quick side note here, though, you want to convert that ahead of time before you have required minimum distributions, because part of that conversion process is you've got to kick out those required minimum distributions in that year of conversion. So if you're thinking about doing this, go ahead and do it right around the 70, 70 and a half, 71. Don't necessarily wait until you hit that age 72. You can do this up to $100,000 per person. Actually, it's not limited by your required minimum distributions. It's $100,000 per person limitation. Now, this does have to go to a public charity, no private foundations. We can't do normal donor advised funds. There's some special flavors that are allowed, but the normal ones we can't do. You're not sending it to a charitable trust or anything else like that. We do have a new rule on this that came up because Congress changed the rules recently that allowed people age 70 and a half or older to continue, if they have earned income, to make contributions to IRAs that create an above the line deduction. Well, if you're doing that after age 70 and a half, you actually have to burn through those post 70 and a half deductions before your qualified charitable distribution will be this clean transaction. Before you burn through those, it's going to count as income and a deduction. And the reason Congress did that is they just didn't want the same person to, after they reach age 70 and a half, to say, oh, I'm going to take an above the line deduction to put money into the IRA, and then I'm going to pull that money out and send it to the charity through a QCD. So they were trying to avoid that because that's essentially an above the line deduction for charitable gifts. And so that's why they put this wonky rule in to prevent that for folks at that age. The fourth suggestion is you can consider IRA gifts even without or above required minimum distributions. As I mentioned, you can give more than your required minimum distribution. Now, again, especially if you're not using those tax deductions anyway, this can be a tax smart way to give. This is money that you've earned, that you've never paid income taxes on, and now you never will pay income taxes on. Well, you know, I'm a professor, so I like to give quizzes. So here is a quiz for you to take, and I'm pretty sure everybody's going to pass that. If you're a donor or a client age 70 and a half, how much can you transfer via the qualified charitable distribution? What if your RMD is 25,000 or 0 or 200 or 2 million? Actually, doesn't matter. The answer is always $100,000, but it's something to keep in mind. So again, the idea is, especially if you're not using the tax deductions, this is a great way to give. Tax avoidance is a smart way to make gifts.
You made my pulse quicken there a little bit with that quiz popped up on the screen.
That's right, exactly.
Bad flashbacks. I might just throw one quick thought in there.
Yeah.
This is great stuff. We do quite a bit of work with corporate executives. And so on the rollover, there's lots of issues to consider. And the QCD is a wonderful technique. But we're always looking first before jumping into that, rolling the 401k into an IRA, if there's company stock in the 401k that is significantly appreciated in value. At times we can look at and see, wow, there's really an opportunity to use this NUA, net unrealized appreciation technique, where you strip out the company stock, pay only capital gains tax on the basis, and then can retain and roll over the rest to an IRA. And so maybe just something to consider additionally, especially if you do happen to be in that, you know, you work for a corporation for a long time and have a lot of company stock in your plan.
Mm-hmm.
Still
Yeah,
a
absolutely.
wonderful tool that can be used. Yep.
That's right. And, you know, and that's why it's great to, you know, have as a comprehensive financial advisor where you're looking at all the pieces simultaneously, because here I'm just sharing the charitable piece, but you got to coordinate that charitable piece with all of the other animals that have to align correctly. If you're going to do that kind of a rollover.
A lot of interdependency of recommendations and overlaps. So yeah, sometimes
Absolutely.
some trade-offs at play. Yeah.
Yes.
Great stuff.
As I mentioned, if you are going to do a rollover, and whether it makes sense or not, that's a more comprehensive question. But if you wait until after you've got required minimum distributions, you actually can't get out of that RMD for that year of rollover. Part of the rollover process is to kick out that RMD before it converts into an IRA rollover. So again, if you're going to roll over, you might think about doing that at age 71 or 70 before you've got those RMDs, so that you could take care of them that way. The fifth suggestion is the IRA beneficiary gift. Now, what's this all about? Well, here's the reality. Retirement plan assets, qualified plans that are inherited by folks other than charities, that tends to be family, those are going to be reduced by income taxes. A lot of people think, oh, I don't have that 12 million or married couple 24 million or whatever it is. I don't have to worry about taxes in estate planning. Well, I've got some bad news. You may not have to worry about estate taxes, but you sure in the world do need to worry about taxes in estate planning. You got to worry about income taxes. Let's take a quick example. Suppose you got just two assets, $1 million IRA and $1 million house, and you want to leave half to a child and half to a charity. Does it matter which goes where? Well, let me show you what happens when you do it wrong. You have that $1 million house, it goes to the charity. Charity's happy with that. You send the $1 million IRA to the child. Well, when the child pulls that money out, they're going to have to pay income taxes on that. So top federal tax rate's at 37%. And just to make it a really sad situation, let's make them live in the state of California, where the top state tax rate's at 13.3%. That means your $1 million that you just sent to the child, that's now less than $500,000. And here you thought you didn't need to worry about taxes in your estate planning. Well, even worse, the Secure Act now requires faster withdrawals. We already knew that the Secure Act was going to require those withdrawals within 10 years. And now IRS is making noises that they want to make that requirements, that withdrawals starting in year one. So wow, whatever that lands up being, the reality is it's going to be a lot of taxes. We're going to have to pay them earlier than we would like.
I think, I don't know this for sure, but I believe I saw a mention that California, there's a proposal to move their top rate to 15%. So if that's true and that passes, you're going to update your slide here to make it even more.
Yes, update my slide. And also we will have to deal with the new wave of immigrants.
That's right.
California, because we already got a lot of them.
You're going to get pushed up even higher. Yeah.
That's right. So let's look at the right-hand side. This is where we do it the right way. We send that IRA money to the charity. Why? Because they're tax exempt entity. They don't pay any of those taxes. So they're just as happy with the IRA as they are with any other asset. We send the non-IRA money or the non-retirement plan money to the child, and they are much happier because that $1 million inheritance, well, it stays as $1 million of cash once the house is sold. So they're happy for that. Do want to mention this. This is just a quick side note. Sometimes people get confused, and you'll hear as somebody say that, oh, you don't want to put the charity as like a 10% beneficiary on your retirement account designation because they're not a, quote, designated beneficiary. And so that could accelerate the RMDs for other beneficiaries. And I got to tell you, that's a problem with so many solutions. It's not in the least a problem. Let me give you a quick example. If you just pay out the charity's share before September 30th of the year following the participant's death, none of those rules apply. And honestly, I've worked with nonprofits all over this country. I've never found a single one that said, no, just leave that money in the IRA. We don't want the cash. They all want to go ahead and get it out as soon as possible. Other ways you can get around it. If for some reason you didn't want to pay out the charity their share that quickly, the beneficiaries could separate the accounts by the end of the year following the participant's death, or you could roll it over into the spouse's IRA. Or if you want to get really sophisticated, you could go ahead and separate that into two different retirement accounts, one that has 100% a charitable beneficiary and one that's 100% family beneficiary. And that's just if you want to get real particular about which accounts you're going to pull the money from. But a lot of different ways around this. So just all of that to say, if you hear this is a problem, it's a problem that's not a problem. So we'll just leave it that way. Well, those are some strategies for tax avoidance. However, tax deductions can also be helpful. And it's another way that we can get the government to match your charitable gift, making your giving more powerful. Now, what are some problems with tax deductions? Well, with higher standard deductions since 2018, fewer people are itemizing. And if you aren't itemizing, you can't use those charitable tax deductions, right? Well, not so fast. we have what Scott's already mentioned, which is the bunching solution. Let's suppose we got somebody, and right now for a single person, the standard deduction is $12,500. And let's say that person donates $10,000 a year. Well, if they donate $10,000 a year directly to the charity, they're never going to get any tax advantages of that if they're donating cash, because they can't ever use that deduction. The standard deduction is always going to be bigger. However, you got some financial flexibility. If they just stuff all 4 years of giving into their donor advised fund in year one, they take a big tax deduction in that year and get the value of that. And then in the subsequent years, they'll just take the standard deduction. Again, it doesn't change when they are transferring money to the charity, but it allows tax planning because, as Scott says, it's a time machine. We can pull forward those deductions into the current year. And of course, what's the best way to pull those deductions forward? Well, let's stuff some appreciated assets into that donor advised fund to pre-fund those years of charitable giving. So we do get some tax benefits for non-itemizers that we've already mentioned: donating appreciated assets, donating from IRA or IRA rollovers, or we can bunch donations into some big giving years so we can take that tax deduction in that particular year. However, there are ways that we can use charitable deductions for folks who are itemizing. Let me share with you some wonky ways that you probably haven't heard of before. One of those is you can get an immediate deduction for donating the inheritance rights to homes or farmland. So let's talk about this. It's called a retained life estate deed for homes and farmlands. And basically, it's a way you can transfer the inheritance rights to a charity. Now, unlike a will, you can't change your mind. Once you record this deed, that charity owns those inheritance rights. It is transferred by a deed. It's real straightforward. Use a standard deed. And let's say if John A. Donor owned the property, you would just write a standard deed that says to John A. Donor for life, remainder to your favorite charity. And I'm subliminally trying to rep Texas Tech Foundation there again. Now, you can donate these inheritance rights to personal residences or farmland. And because you can't change your mind, it creates an immediate income tax deduction. You can do this with second homes, vacation homes, even a boat with bathroom, cooking, and sleeping facilities, as long as you occasionally use it as a residence. Now, you can get a pretty substantial tax deduction for donating those inheritance rights. This is interest rate sensitive, and under current interest rates, it's a little over a $400,000 deduction you would get if an age 55 donor transferred the inheritance rights to $1 million of farmland, just to kind of give you some round numbers there. Obviously, that deduction gets bigger if a person is older than age 55, and it depends upon the interest rates that are being used. Well, most of you know we are kind of in a spiking interest rate environment. One of the things to keep in mind with these, which is important in planning, is that when you do this transaction, you can use the current month's rate or either of the prior 2 months' rates. So if you're in a spiking interest rate environment, sometimes it might be one of these transactions we want to close by the end of the month so we can use that interest rate from 2 months earlier. Just
That's
as
really
a quick,
pretty.
go ahead,
I'm sorry.
Scott.
Yeah, just a question for you. I mean, that's really pretty amazing. So let's say you have an operating farm and you donate the inheritance rights because maybe no one in the family wants to continue the farming tradition. They've all moved away to the city. They're doing well on their own. I think of a scout camp I work with in northern Wisconsin. They had farmland donated to them, but you could continue farming that, making a living off of it as long as you want. It's just after you're gone that the farm transfers to that charity, but you can get a really substantial deduction up front.
That's right.
Cool.
And it doesn't have, you can donate the inheritance rights to just one part of the farm. You could even donate the inheritance rights to, say, 10% of one part of the farm or whatever it is that fits your plan. You can donate that share of the inheritance rights in advance and take that tax deduction. Now, again, go ahead, Scott.
Well, I was going to say, in the boat example, well, that's a fun one. I mean, I suppose you can even factor that into the purchase price. If I could convince my wife that we need a nice cabin cruiser and say, well, we'll use this for the next however many years, and then
that's right,
donate the inheritance rights right up front. You could really almost effectively recoup a significant amount of the purchase price.
It is true that you can get a pretty big tax deduction up front. And like you say, you can do anything you want with the property for the rest of your life. You can lease it out, you can use it, you can, whatever you want with it. The only thing you're giving away is those inheritance rights.
Very interesting.
Yeah. So some other things to keep in mind. One is the idea of combining deductions and Roth conversions. Now, the reason these two things can work together is that Roth conversions and charitable planning can work together to match up the income and the deductions. So the idea of a Roth conversion is this. Let's say I've got $1 million in a standard IRA. Anything I pull out of that's going to be taxable. If I then convert it into a Roth IRA, anything I pull out of that Roth IRA is going to be tax-free. And the reason I do that is not just the money I've converted is tax-free, but all the growth on that money for all those subsequent years, that I can pull out tax-free as well. Especially when we're getting into this environment where if we've got inflation going on, that means a lot of assets are going to go up in value, at least nominal value, even if their real purchasing power doesn't go up. It means a lot more, at least nominal growth. Well, if we get that stuff converted over into a Roth first, then we're not going to have to pay taxes on any of that additional nominal growth. So the Roth IRA conversion can be a really powerful strategy, but there's a downside. When you convert that money, you got to pay taxes on, or at least you got to report it as income on all that money that you convert. So doing that Roth conversion can create a big spike in your income. And whenever we have a spike in income, we're going to be particularly interested in finding some offsetting deductions. Where do you find those deductions? Well, that's what charitable planning is all about. Whether it be simply, hey, let's pre-fund our future giving by stuffing a bunch of money into the donor advised fund. We can do that by donating appreciated assets. There's also more complicated instruments, charitable remainder trust. That's where we take an asset, we set it aside, we can sell it with no capital gains taxes up front, so we still have the full asset intact. We can earn income off of that for the rest of our lives. We get a big upfront tax deduction because whatever's left over at the end of life goes to the charity. We've got some things like charitable lead trust. That's another way that we can take an asset, put it in the trust basket. It'll fund the next 10 or 20 years worth of charitable giving. Then the asset comes back to us at the end, but we get an upfront tax deduction for all 10 or 20 years worth of that giving. Charitable gift annuities, even for big donors, private family foundations, or things like that weird deed I was just talking about,
Right.
for giving inheritance rights to farmland or retained life estate deed. So go ahead, Scott.
Well, I was just going to say, I should mention there may be some folks who are later listening to an audio recording of this. Dr. James has some great slides, and so we'll also be posting the video of this as well, which can kind of help you read through. And as you have some really good examples in there. I love this strategy. I've written a related blog post as well. And I think another element, some of the people that this is particularly interested to, if they've gotten to that point where there's a significant amount of assets, probably more than they need for their lifestyle, the Roth conversion, as you mentioned, transferring that future appreciation into tax-free dollars. That's great. It's great legacy planning. It's also very interesting, paying the tax on it. And if you're contributing the gift, you're removing those dollars from the taxable estate. So it's not just that income tax, but the potentially shrinking the size of a federal or state. We have a pretty healthy state estate tax here as well in Minnesota. So
Yep, you guys are good at taxes, so that means planning becomes even more valuable. Absolutely.
taxes
So yeah,
and snowballs. Yeah.
yeah, that's right. Yeah, yeah, absolutely. So that if you get somebody who's in an estate tax situation, oftentimes it's kind of planning essentially creates a double bonus because you're getting the income tax benefits and you're also getting the estate tax benefits from the charitable planning along the way. Well, those are some ideas to keep in mind. I teach 2 semester-long courses on this stuff, so I can just keep talking and talking about how we can get into all sorts of wonky options and choices along the way. But those are some things to think about, especially as we're nearing the end of the year, as you're thinking about your charitable giving. So I'll go ahead and stop there and turn it over to you, Scott, if you have any other thoughts or comments.
Yeah, that was great. That was quite a list, and very valuable planning topics. We have a few questions here. Some I
Sure.
solicited ahead of time, and maybe I'll run a few things by you and see if we can stump you.
Go
So
for it.
I notice more and more when I'm checking out at a store, and put my credit card in there, and they ask, "Oh, would you like to round up to the nearest dollar to support this or that cause?" And it sounds great, feels nice. But I've heard there's some skepticism in that, well, the company then is claiming a charitable deduction for those dollar amounts given. Do you know anything about that? I really haven't looked into it much.
So, the reality is that that's something that you do that you're not going to be doing for tax benefits,
Yeah.
right? That's more
Mhm.
of just a convenience pocket change sort of decision.
Mhm.
And honestly, I think we have more impact when we start thinking bigger picture and we start thinking, instead of just, pocket change choices, right? Give a dollar here, give some pennies here. If we start thinking about, okay, here's my wealth, here's what I'm going to use of it during my lifetime,
Mhm.
and I've got this other, what do I want to do with it? Do I want to just bury it in the ground, or do
Yeah.
I want to actually take it out and start doing some stuff with it,
Okay.
making an impact with it?
Yeah.
And I think that's where we can really start thinking about how we want to use our wealth in the way that's most meaningful for us. And so that's a really different conversation than, just sort of the pocket change, socially appropriate kind of,
Yeah. Right.
you would call them sort of social compliance gifts, right?
Got
They're
it.
not
Yeah.
really kind of planning for impact where, one of the things that, and I didn't mention, Scott, we talked a lot about donor advised funds. Great things about these donor advised funds is if you sort of start building up those funds through your giving, it'll build up to the point where you may be able to have an impact that you didn't think about normally, like maybe enough to, hey, maybe I can set up a whole permanent scholarship fund, or I
Mm.
can do something
Mhm.
that, some big impact for a campaign in a cause that's been important in my life that maybe I couldn't have done if I was only, making those a
Right.
series of those small $50 decisions.
Right.
Um,
Yeah.
so, uh, so I would just say, that's fine one way or the other, but that's not really the sort of thing that moves the needle, that makes the impact for causes that have been important in your life.
Yeah. Your term social compliance reminds me of, so our son is in Cub Scouts, and they just had a popcorn sale, the big fundraiser for the year. And it's great popcorn, flavored, caramel, chocolate covered up. It's like $25 a bag. And one of the other dads told me, he said, the way to pitch it is it's a charitable contribution and you get a bag of popcorn with it. So it's like,
Exactly.
yeah,
Exactly.
yeah.
Yes. Yes.
So, here's something I think is a good question we get asked from time to time is, last year at the end of the year, there was tornadoes in Kentucky that caused a lot of damage. We gave some funds as an organization. We just had the hurricane impact Florida. So there's all types of, geopolitical events, humanitarian issues, but, something like that, like natural disaster, oftentimes people are inspired to give and to try and help. In the moment, do you have any advice in terms of making sure that your money is going to the right place in
Yeah.
something like that? So you're not, you're not getting scammed, or it's not
Yep.
being effectively used.
Yeah, absolutely. So I'm going to say 100%, especially for that kind of giving, make sure you're giving to an organization that has a long history, right? If it's something that, hasn't been there for, at least a generation or two, I would say there is so much of this kind of, fly by night places that pop up because people want to help. And, it is much safer, much more likely to have an impact if you're working with organizations that know what they're doing, that have been around for a while, that this isn't their first rodeo, that they know how to make that impact when it comes to these situations.
Mhm.
So
Mhm.
that would be my recommendation. And whether that is, a well-known national organization, or maybe if you've got a church affiliation that's got some long-standing
Mhm.
organizations, I would definitely focus on those organizations that honestly have been in those places for years, decades, multiple generations, that's who's going to have the most impact and the least likely to be just the pop-up places that are going to be, grabbing the dollars and then they disappear before we know what they've done.
Yeah, that many times in many areas of financial planning, there are good strategies, but there's trade-offs, there's things to consider. And, it's not like just picking up the hammer and it works in every situation, right? You need to consider where it's appropriate. And so any other in this wonderful area of trying to do good with your financial resources, any other major pitfalls or areas of concern, red flags, things that you see, common mistakes maybe that people should look for or be wary of?
I think it's really just a matter of, in terms of where you're going, you want to give to either organizations or people that right? That either it's an organization that just has the history of they make a difference, or it is no, I actually know the people on the ground who are doing this
Right.
work, right? And so that you want to focus on. The other thing I would say is, if somebody comes to you and they've got a deal that says, oh, we're doing this charitable thing and you're going to come out making money, run away as fast as you can, right? These are ways that you can make a charitable impact in a way that is tax efficient, in a way that is tax smart. But if you don't have any charitable goals, you shouldn't be dealing with charitable planning, right? So avoid those, because there are, from time to time, there'll be different sort of scammy type things that the IRS will come in and shut down from, things that that are trying to be abusive on the tax code and all that sort of thing. So, definitely you want to avoid those. You want to work with reputable organizations or those where you actually know the people, not the people asking for the money, but the people actually doing the work. Those are the places to go, and to make sure that the places that you're giving to, even if they've been around for a long time, make sure they share your values and goals, right? Because that may not always be the case, and so you want to make sure that you're supporting things that that you believe in, and that it's going to make the kind of impact that you want to see happen. I think it really all starts with financial planning, because the substantial charitable impact starts with, first, do I have enough for the rest of my life? And once that answer is, yeah, looks like I do, then what do we want to do with the rest of it? Is it a situation where, hey, does the family really, do the kids really need this, or are they doing okay? And if they're doing okay, then, well, what are some other things we might do with that? Whether it's in an estate gift or it's in something that we do now. So I think that's really where it starts in terms of having that big impact.
I completely agree with you. I think a lot of people would like to support a lot of different causes and charities they like, but until there's sense of we're okay, we have enough, and this is maybe excess funds, or as we're accumulating that we're on track, we're funding our goals at an appropriate level, we will be okay. What do we have to work with as time goes on to make gifts? And I think that's incredibly powerful, to kind of give yourself that permission slip of knowing that, okay, we're okay. We've looked at this every which way. We've stress tested these scenarios. We've thought about long-term care situations. We've thought about helping kids or grandkids, all those types of scenarios. We've modeled out market disasters and things along those lines, and we're still okay. And then you kind of understand what your budget might be for that. That's fantastic. So we've talked a lot about kind of tools and techniques, tax techniques. We just talked about financial planning techniques. I know you've done a fair amount of work on the softer side of things, more qualitative side of things, the behavioral economics or the psychology of gifting. Pretty big picture question, but anything you can share there? Is there any way of quantifying that, being involved in giving and philanthropy makes us feel better or happier? What can you tell us about that?
Yeah, sure. Well, there's no doubt that it does. I mean, there's even been some cool experimental research where they would give people money, and some people they say, "Okay, take this money and spend it on yourself," and then the other people take this money and give it to someone else, and then it turns out that the sort of health indicators of this second group get better, and their stress levels go down, and believe it or not, I deal a lot in statistics, and people who are charitable, that is, for example, people who have a charitable component in their estate plan, they actually live longer than
Hmm.
others of their same wealth category who don't have charity in that plan. People who are charitable, they tend to be more socially engaged, they tend to live longer. These are just realities of how, when we're doing something that is meaningful, and that's really what charitable planning is all about, is how can we take what we have and make a meaningful impact with it. That's an important part of life. It's not just all about accumulating and consuming, right? There
Hmm.
are other things that are
Yeah.
important goals, and a lot of times charitable planning is an important part of that, as sort of being a whole person beyond the spreadsheet.
Mhm.
And charitable planning can be a big part of making the kind of impact with your life that you want to make while you're still here.
Mhm. Yeah. What about children? Any thoughts on helping instill that habit or getting them thinking along those lines?
Yeah, it is something that, depending on the situation, sometimes we can have situations where maybe we can involve children in. We have got this donor advice fund. Let's get
Mhm.
together and talk about where do we want it to go out to. Obviously at the high net worth category, maybe even talk about private family foundations
Right.
where we have a board that they sit on and get involved in that sort of thing. So certainly we can involve folks in those things, and also it's a way to see where those values are going to differ and how you might want to take control of some of those places and make sure that your values are the impact that you want to have is what's going to be happening.
Yeah, it's interesting. I found it's been a good area where you can start having some conversations around family values and also financial situation and financial stewardship and working together with between generations in terms of what are the goals and yeah, very interesting. Sometimes that's a nice lead in where maybe things have been kept more private or separate in the financial scope of things. So
Well, and it's often the case that, as estate planners, I'm an estate planning attorney, and we often think in terms of, the goal is to maximize what we leave to the kids. But that doesn't necessarily make them better off. Sometimes
mhm,
people can be made worse off
mhm,
by, ending up being trust fund kids or whatever you want to call
right.
them. That there's a limit to the benefits of how much you're going to transfer to family members. And so you may want to be thinking about, again, it comes back to those important concepts about values and meaning. What's important and what are you trying to accomplish along the way?
Mhm, mhm. Yeah, maybe I'll circle back to technical stuff just because I'm thinking here we are early November. A number of the issues or the strategies you talked about, calendar year is what a lot of these things run on for charitable giving. And so it's in some of the techniques, it's not too late to capture something. End of last year, we had a new client, a business owner came in, had worked his whole career to build up this business, sold it, large check, large lump sum, and was coming in talking to us about, okay, here's these dollars. What should we do? How do we live off of this for us for our life? We don't want to screw this up. Oh yeah, there's this tax bill we need to leave significant funds for. Come to find out, none of these conversations had happened around charity or philanthropy, and they were very interested in this. And so, kind of, it was getting a little tight with the timeline, end of year, but we were able to do a charitable lead trust at the end of the year and essentially go backwards because it was still within 2021 and wipe out a large amount of that tax bill and fund that pot of money that'll support their causes for a long time. But I guess to just mention that if anyone's listening, now or in the recording in the near future, keep an eye on that calendar deadline. And there's a variety of techniques that can go back and still capture what was done within this calendar. Is anything?
Yeah, and honestly, as a charitable financial planner, when you say they sold the business and then came and talked to me about the charitable plans, it's like, oh no,
Yes.
because now you got to pay that capital gains tax, right? It's too late
Mhm.
now. You sold the
Mhm.
business. But if we'd been able to have those conversations a little bit earlier, then it could have
Mhm.
been okay. Let's structure this sale in a way where we don't have to pay all those capital gains taxes, and
Right.
so it's always, we want the clients to come earlier, because a lot of those opportunities can be lost if we can't have those conversations ahead of time.
Mhm. Mhm. Very good. Long-term planning. Get ahead of things. I love it. It's always better to have more runway rather than less. So,
Absolutely.
well, this has been wonderful. Can't thank you enough, Dr. James, for all your insight and experience. And this has really been an enjoyable conversation. So, uh, thank you very much.
Thanks so
Anything,
much, Scott.
anything else you'd like to add?
Nope, think that's everything. Appreciate the invitation.
Okay. Well, take care.